But we're going to talk about this. This is an article. If you thought NFTs were crazy, wait till you see how they're taxed. Consumers are grappling with a tax code that doesn't formally address how NFTs can be used to denote digital ownership. It's all fun and games until the tax man comes knocking. I happen to like that. It's true. I think I'm going to adopt that phrase for myself. It's all fun and games until the tax man comes a knocking. After exploding into the mainstream this year, NFTs are creating a new class of headaches for accountants seeking clarity on how crypto transactions should be reported to the IRS. The market for non-fungible tokens, unique digital assets that are often traded like collectibles, soared to more than $44 billion in 2021 as art houses and sports leagues capitalized on the latest craze in crypto. But while surging demand for NFTs has unlocked new revenue sources for online creators and startups, it has also forced consumers to grapple with the tax code that doesn't formally address how such tokens can be used to denote digital ownership. At the most basic level, using crypto to purchase NFTs can trigger a capital gains event for both the buyer and the seller. Depending on the NFT, owners could also wind up on the hook paying more taxes if their new token confers ownership of a physical asset or additional economic benefits. This is something that most people don't think about but all these things that they kind of tie in with NFTs also have tax consequences. Lawmakers have launched a bipartisan effort to mitigate the tax hit from smaller crypto transactions. But as celebrities from Steph Curry to Roger Stone dive into digital collectibles, the booming market is creating new risks that crypto traders might be running up their tax bills without knowing it. Notably, while NFTs represent only a small fraction of crypto's ecosystem, the IRS is training its sights on digital assets, which the commissioner identified as a significant contributor to the government's estimated $1 trillion in uncollected tax revenue. This is such a wild number. Again, he's back to $1 trillion. It went from 200 billion. They were talking 300 billion. This is what the tax gap we talk a lot about on this show. And one of the reasons why we talk a lot about it is because they use it as the cudgel to pound us all about how they have to regulate crypto because there's so much out there, and why they have to go after our bank statements, and why they have to do the Venmo statements and all of this. And the reason is the tax gap. And again, the size of that tax gap is only a guess at best. And oftentimes, they were always guessing it was 200 billion, 250, maybe 300 billion. Yet last year when they started doing the Build Back Better plan and they were trying to spend $5 trillion, they were saying that they could tap into the tax gap and pay for it itself just by that. And of course, that was all a fallacy and a pipe dream, but that didn't stop them from using these numbers and exaggerating these numbers. So whenever now they want to make it look very important and why they need to really crack down on it, this $1 trillion tax gap kind of comes up. And again, I think it's a false number. I think they know it's a false number because otherwise they wouldn't trade it off so often and use these much lower numbers usually. So again, sometimes you'll hear this $1 trillion number, but it's generally a much lower number that they use. So far as the agency has struggled to keep pace with the market, it would be very helpful for the IRS and state authorities to clarify how the gains and sales of NFTs should be treated. Many crypto participants don't think of taxes until long after sales occur and are caught flat-footed when they have to take taxes into account. Well, this happens to a lot of investors, new investors, when they've, the wash sale rule and things like this that catches a lot of people by surprise because they're not aware of it. The confusion over the tax implication of NFTs comes as policymakers attempt to navigate a dizzying array of online marketplaces and trading platforms where new payment systems have displaced traditional modes for commerce. Even uneven oversight on these markets prompted Joe Biden to sign an executive order earlier this month, which we talked on this show, on Crypto Tuesday, demanding a whole of government assessment of U.S. crypto policies. NFTs are typically purchased using popular cryptocurrencies, most commonly Ether, Ethereum, and the transactions are recorded on decentralized public ledgers known as blockchains. Purchasing an NFT usually doesn't confer the buyer copyright to the image or artwork, similar to owning an art print or rare trading card. But sellers can offer a variety of other dividend-like benefits to drive up interest in the digital asset. I'm just going to repeat this because I think this is important. It would be which is why they highlighted it. It would be very helpful for the IRS and state tax authorities to clarify how gains and sales of NFTs should be treated. Fair enough. Sussing out the other benefits can complicate sussing. I don't know what that means. Can complicate an NFT's tax profile. Coinbase and some trading platforms, including the most widely used NFT marketplace, OpenSea, are partnering with tax specialists to help users determine their obligations. However, with the IRS unlikely to offer concrete guidance on the new assets anytime soon, accountants say they're only making an educated guess in determining how the tax code applies to NFT transactions. It's so empirical. It's like grabbing smoke. Depending on the token, the timing, and who's doing the selling, NFT transactions could be taxed as income, shorter long-term capital gains, collectibles, or as dividends. Very interesting. It really depends. Kind of like crypto can be an income, long-term capital gain, short-term capital gain, no gain, depending on whether you buy, sell, what is the taxing event. Full-time artists who sell NFTs might view their proceeds as income. Other permeations can occur if the token has been fractionalized, meaning if multiple owners purchase partial shares of the same NFT. In instances where ownership entitles the holder to other digital assets that are airdropped into their digital wallets at a later date, that could be viewed as a dividend or an interest payment. If the token has been linked to ownership of a physical asset, anything from a pair of sneakers to a Florida home, those could carry tax obligations as well. This being the first tax season since the tokens went mainstream, accountants are navigating their clients' filings by drawing parallels between NFT-linked transactions and situations where there's clearer IRS guidance. Because there's no direct guidance for NFTs as for such as crypto, you have to sort through it by analogy. A fundamental challenge is that most of the transactions are conducted entirely with digital assets. Buying an NFT with digital assets is equivalent to selling your crypto for US dollars, then using those dollars to purchase the token. The reverse would be true for whoever is making the sale. Each link in that chain is potentially subject to capital gain taxes. If you're buying, selling, or trading tokens frequently, something that has become common in video game and metaverse applications where users trade crypto for character avatars and digital paraphernalia, often represented as NFTs, your tax return can become exceedingly complicated. The process becomes even more difficult if people use multiple self-hosted digital wallets, which are used to hold crypto, to facilitate their trading activity. And since most trading platforms are decentralized and don't have access to the transaction data included in each user's wallet, it's ultimately on the trader to assess what they owe the IRS. And this is what the IRS wants to stop. Right? The IRS wants to tell you what you owe. They don't want you to tell them what you owe. We are definitely seeing a major increase in not only customer counts, but also complexity in the customer's activity. They are surprised at the figures that they're looking at. Many of these technologies are still in their infancy, and it's unlikely the IRS will offer direct guidance on NFT-related transactions in the near future. They don't even understand it. While the IRS is aware of and monitors the developments with digital assets, the IRS has not issued specific guidance on NFTs. With thorny tax issues popping up around even the smallest crypto transactions, some Congress people have introduced legislation that would exempt personal transactions made with virtual currency for taxation if the gains are $200 or less. That kind of makes sense. Maybe more, it's got to be higher than $200 though. The digital economy is rapidly evolving, but only tax code is lagging behind. Currently, the burden to report and calculate gains on virtual currency transactions falls on the consumer. This includes purchasing NFTs. In the meantime, the IRS now asking Americans to log their virtual currency transactions on the first page of their individual tax forms. The partnerships between crypto companies and tax specialists are intended to help users with their returns. In the absence of any type of software, I would say it's virtually impossible for anybody who has a couple of wallets and multiple coins or NFTs to figure out their taxes. I have to agree with them. This is not like buying a stock. They are platforms. These are not companies that are visibly into what's going on in your wallet. Very true. I think that's very good. I just thought it was a very good article in that it spelled out many of the complications that many people don't think about. You know, when you're buying an NFT or any of these, or even cryptocurrency, and the tax implications of how that all works. Many people